Hi, I'm John Nicholas. In this video, I focus on how reducing fees and taxes can improve your investment returns and increase the growth of your money over time. Many people are not getting the returns out of their investments they should be. Two major reasons for this is that they pay too much in fees and too much in taxes on their investments than they need to. As a result, their wealth is not growing as much as it could be. With regard to fees, it's common for people to pay about 1% of their investments annually to managers of mutual funds and ETFs. This includes management fees, trading costs, and administrative charges. Fees are even higher, 2% management fees and 20% of profits in the case of hedge funds and other alternative managers. The fees you pay reduce returns and therefore reduce the growth of your wealth over time. You might say that the manager's fees are worth it if the manager outperforms the market or outperforms their benchmark. Very few managers, though, outperform the market or their benchmarks. In this chart, you can see that over a 15-year period, less than 15% of active stock and bond managers beat their benchmarks. Many of these managers produced average, market-like returns before fees and below-average returns after fees. You have a better chance of achieving higher long-term returns by investing in low-cost, index-type funds, where fees typically range from 5 to 30 basis points annually, rather than speculating that you will select an active mutual fund or ETF that consistently outperforms the market. With regard to taxes, active fund managers generally have higher portfolio turnover compared to passive index funds. This is because active managers are frequently trading, buying and selling securities in an attempt to beat the market. Some active equity managers have 100% annual turnover of their portfolio positions. Turnover often results in recognition of long and short-term capital gains, which you pay the taxes on. Short-term capital gains are taxed as ordinary income, the highest federal rate of which is currently 37%, and the highest long-term capital gain rate is 20%. Plus, if you are in a higher tax bracket, you pay an additional 3.8% net investment income tax. So, active investment with its higher portfolio turnover and higher taxes can cost you a significant amount of return. As you can see in this chart on equity managers, the after-tax return of the index funds at 9% is 22% higher than the 7% return of the actively managed funds. In addition, many people pay more in taxes on their investment returns than they need to, because they do not have their assets allocated optimally between taxable and tax-advantaged accounts, such as IRAs and 401ks. Improving asset location, that is, where your investments are held between taxable and tax-advantaged accounts, can improve your after-tax returns. Here's an example. Assume there are two investment portfolios consisting of half stock funds and half bond funds. The first consists of index-type funds and has an annual investment return of 7.5% after fees and taxes. The second portfolio consists of active managers averaging 1% in fees and returns 6.5% annually. A 1% difference in return, 7.5% to 6.5%, may not seem to be much of a difference, but it can make a huge difference in the growth of your wealth over time. The longer the time period, the larger the impact given the effect of compounding. For example, say you are 35 years old and have $100,000 invested for your retirement in 30 years at age 65. Over 30 years, your $100,000 compounding annually at 7.5% turns into $875,000. At a 6.5% rate of return, your $100,000 turns into $661,000. That's $214,000 or 25% less. Not good. It gets even worse when, as some investors do, you pay an additional 1% of your return in taxes. So for example, if the return of the active manager portfolio return is 5.5% after taxes, your $100,000 investment grows to $498,000 after 30 years, which is $377,000 or about 43% less than the 7.5% return of the index portfolio. These subpar results happen to investors all the time, unfortunately. Rather than spending your time trying to select a manager who can outperform the market, and as noted, few do, you should work to reduce the fees and taxes on your investments, which as shown can make a huge difference in the growth of your money over time. The end result, again, of paying too much in fees and taxes on your investments, lower returns, and lower compounding of your wealth over time. So, how do you clean up your portfolio and improve your investment returns? First, clear out high-cost, high-turnover active managers from your portfolio. These managers are likely to underperform index-type funds which track the market, and these managers often have trading strategies which produce significant recognized capital gains upon which you pay taxes. Second, review your asset location and make sure that your assets are effectively allocated between your tax-exempt and taxable accounts. You do not want to be giving your investment returns to the IRS. If you would like to talk about these issues in more detail, or would just like to receive our newsletter on financial topics, give me a call or send me a note. Thank you.